Here's something nobody tells you when you hit 60. The game completely changes, and if you don't change your strategy with it, you're going to get annihilated. I don't care how smart you think you are. I don't care how well you did in your career. If you're playing the same investment game at 65 that you played at 35, you're making a catastrophic mistake. And I'm going to tell you exactly why. I'm Kevin O'Leary. I've built companies worth hundreds of millions. I've invested in over 100 businesses on Shark Tank. I manage a portfolio that generates consistent returns year after year. And I'm telling you right now, if you're over 60 and you haven't restructured your entire financial strategy around capital preservation and income generation, you're in serious trouble. You just don't know it yet. Let me be brutally honest with you. Most people over 60 are invested like idiots. They've got money scattered across accounts they don't understand. They're chasing stocks, their neighbor, recommended. They're holding on to losers hoping they'll come back. They're paying fees they don't even know exist. And worst of all, they have no plan for actually generating the income they need to live on for the next 20 or 30 years. This isn't a theory for me. This is personal. I watched my stepfather struggle financially in retirement because he made dumb decisions with his money. He was a brilliant man, a United Nations economist, spoke multiple languages. But when it came to managing his own portfolio, he was lost. He trusted the wrong people. He paid ridiculous fees. He had no income strategy, and he paid the price. I learned from watching that disaster. I swore I would never let that happen to me or to anyone I could help. So here's what we're going to do. I'm going to walk you through exactly how to protect your capital and generate 10 to 12% annual returns safely after 60. Not speculation, not gambling, actual strategy based on mathematics and discipline. This is going to make you uncomfortable because I'm going to tell you things your financial advisor won't. I'm going to expose the lies the industry has been feeding you, and I'm going to give you a blueprint that actually works. First, let's destroy the biggest myth in retirement planning, the myth that you should shift all your money into bonds when you retire. This is what every cookie-cutter financial advisor tells you. Take your age, put that percentage in bonds. If you're 65, put 65% in bonds. It's simple, it's easy, and it's completely wrong. Here's why. Bonds are not safe anymore. They were safe when interest rates were high and falling. For 40 years, from the early 1980s until recently, bond prices went up because interest rates went down. That trade is over. Done. Finished. We're in a completely different world now. Interest rates are volatile. Inflation is a real threat, and bonds yielding 3 or 4% are not going to protect you from anything. They're going to make you poorer. Let me break down the math for you because math doesn't lie. Let's say you have $1 million and you put 65% of it into bonds yielding 3.5%. That's $650,000 in bonds, generating $22,750 a year before taxes. After taxes, you're looking at maybe $15,000 depending on your bracket. Meanwhile, inflation is running at 3%. Your purchasing power is eroding. You're losing money in real terms while thinking you're being safe and conservative. The other 35% is in stocks, maybe $350,000. If the market drops 30%, which it does periodically, you just lost $105,000. Your bond interest doesn't come close to covering that loss. And now you're scared. You sell the stocks, you go to cash, you miss the recovery. This is the cycle that destroys retirees over and over again. So what's the alternative? You build a portfolio focused on income generation and capital preservation through dividends, not through bonds. This is the strategy I use. This is the strategy that works. You invest in high-quality, dividend-paying stocks and use those dividends as your income stream, not capital gains, not hoping stocks go up, dividends. Real cash hitting your account every quarter. Here's why this works. A portfolio of solid dividend payers can yield 4 to 6% annually. That's more than bonds. And unlike bonds, these dividends grow over time. Companies raise their dividends. Johnson & Johnson has raised its dividend for over 60 consecutive years. Procter & Gamble, over 65 years. These are companies that survived the Great Depression, multiple recessions, wars, pandemics, everything. and they kept paying and raising dividends. So let's run the same numbers with a dividend strategy. $1 million invested in quality dividend stocks yielding 5% gives you $50,000 a year in dividends. That's more than triple what the bonds were giving you. And here's the magic part. Those dividends grow. If the companies raise dividends by 5% a year, in 7 years, your income doubles. Try getting that from a bond. But Kevin, you're saying, what about the risk? What if the stock market crashes? Here's the beautiful part. You don't care about the stock price if you're living off dividends. The stock market can drop 30%. As long as the companies keep paying dividends, you still get your income. You're not forced to sell at the bottom. You just keep collecting your checks. Let me give you a real example from my own portfolio. I own shares in Canadian banks. TD Bank, Royal Bank, Bank of Nova Scotia. These banks have been paying dividends for over 100 years. During the 2008 financial crisis, the stock prices got hammered. But you know what they didn't do? They didn't cut their dividends. I kept getting paid. And when the market recovered, not only did I have all the dividend income I'd collected, but the stock prices came roaring back. That's how you protect capital and generate income. Now, here's the part where I'm going to make some of you angry. You need to fire your financial advisor. I'm serious. Most financial advisors are not working for you. They're working for themselves. They're salespeople dressed up in suits pretending to give you advice, and they're bleeding you dry with fees. The average financial advisor charges 1% to 2% of assets under management annually. Let's say you have $1 million and you're paying 1.5%. That's $15,000 a year. Every year. For what? For them to put you in mutual funds that charge their own fees? For them to rebalance your portfolio once a year? For them to send you quarterly statements you don't read? It's a scam. Here's the dirty secret of the financial services industry. Most advisors don't beat the market. Study after study shows that actively managed funds underperform index funds over the long term, and yet they charge you massive fees for this underperformance. It's insane. You're literally paying someone to make you poorer. Let me tell you what I do. I manage my own portfolio. It's not complicated. I own 20 to 25 individual stocks, all dividend payers, all companies I understand, all companies with long track records of profitability. I spend maybe 2 hours a month reviewing my holdings. That's it. No advisor, no fees, no middleman taking a cut of my wealth. Now, if you don't want to pick individual stocks, fine. Use low-cost dividend ETFs, exchange-traded funds that own baskets of dividend-paying stocks. You can build a complete portfolio with 3 or 4 ETFs. Total cost, maybe 0.1% annually. Compare that to the 1.5% your advisor is charging. Over 20 years, that fee difference is hundreds of thousands of dollars. Your hundreds of thousands of dollars that stayed in their pocket instead of yours. Let me break down the actual portfolio structure I recommend for anyone over 60. This is designed to generate 10 to 12% annual returns with minimal risk. Notice I said minimal, not zero. There's no such thing as zero risk. Anyone promising you that is lying. 40% goes into dividend aristocrats. These are companies that have raised their dividends for at least 25 consecutive years. We're talking about the most stable, reliable companies in the world. Johnson & Johnson, Coca-Cola, Procter & Gamble, 3M, McDonald's, boring companies that print money year after year. This portion of your portfolio yields around 3 to 4% and grows steadily. 20% goes into high-yield dividend stocks. These are companies paying 5 to 8% yields. Think REITs, business development companies, utilities, telecommunications. Yes, they're riskier than the aristocrats, but you're diversifying across multiple holdings, so no single position can kill you. This bucket gives you the higher income you need to live on. 20% goes into preferred shares. Most people don't understand preferreds. They're like a hybrid between stocks and bonds. They pay fixed dividends, usually in the 5 to 6% range. They're senior to common stock in the capital structure, meaning they get paid before common shareholders, and they're more stable than common stocks. I love preferreds for retired investors because they give you bond-like income with better yields. 10% goes into convertible bonds. Again, a hybrid security most people ignore. Convertibles pay interest like bonds, but can convert to stock if the company does well. You get downside protection from the bond component and upside potential from the equity component. It's the best of both worlds. And 10% stays in cash, real cash. Money market funds or short-term treasuries. This is your emergency fund. This is your opportunity fund. When the market crashes and everyone's panicking, you have cash to buy assets on sale. This is also your buffer, so you never have to sell stocks at the wrong time to pay bills. That's the portfolio. 40% dividend aristocrats, 20% high-yield dividend stocks, 20% preferred shares, 10% convertible bonds, 10% cash. Total expected yield 5 to 6% from dividends alone. Add in some modest capital appreciation from the stocks, and you're looking at 10 to 12% total returns annually. Not pie in the sky, not speculation, mathematics. Now let's talk about the rules, because without rules, you'll screw this up. Rule number 1, never chase yield. I don't care if you see a stock yielding 15%. If it looks too good to be true, it is. High yields are often a warning sign. The market is telling you something's wrong with the company. Dividends are about to get cut. The business is failing. Stay away. I see retirees make this mistake constantly. They see a 12% yield and think they found a gold mine. 6 months later, the company cuts the dividend and the stock price collapses. They lose 50% of their capital chasing an extra few points of yield. It's idiotic. Stick to quality. Stick to companies with long dividend histories. Boring is beautiful. Rule number 2, diversify across sectors. Don't put all your money in bank stocks or utility stocks or REITs. Spread it around. You want exposure to consumer staples, healthcare, financials, telecommunications, industrials, real estate. When one sector struggles, others hold up. That's real diversification. Rule number 3, reinvest dividends until you need the income. If you're 60 and still working, you don't need the dividend income yet. Reinvest it. Let it compound. A 5% yield that gets reinvested becomes a 5% annual growth rate on top of whatever capital appreciation you get. That's powerful. Then when you actually retire at 65 or 70, you flip the switch and start taking the dividends as cash. Rule number 4, review your portfolio quarterly, not daily. I see people checking their stock prices every day. That's insane. It creates emotional decisions. Stock prices fluctuate. That's what they do. As long as the dividends keep coming, the daily price doesn't matter. Check your holdings every quarter. Make sure the companies are still healthy. Make sure dividends are still being paid. That's it. Rule number 5, never use margin. Never borrow money to invest. I don't care how good the opportunity looks. After 60, leverage is your enemy. Leverage amplifies losses just as much as it amplifies gains. One bad move with leverage and you can lose everything. There's no reason to take that risk when you're living off your portfolio. Let me tell you about taxes, because this is where most people get destroyed. Every dollar you pull from a traditional IRA or 401k is taxed as ordinary income. If you're pulling out $60,000 a year to live on, you could easily be paying $15,000 in taxes depending on your bracket. That's 25% gone before you spend a dime. Meanwhile, qualified dividends are taxed at long-term capital gains rates. For most retirees, that's 15%. Some pay 0 if their income is low enough. Big difference. If you're getting $60,000 in qualified dividends versus $60,000 in IRA withdrawals, you could save $6,000 a year in taxes. Over 20 years, that's $120,000. Same income, way less tax. This is why I tell people to build taxable brokerage accounts, not just retirement accounts. Yes, you give up the upfront tax deduction, but you gain flexibility. You control when you realize gains. You get better tax treatment on dividends, and you're not forced to take required minimum distributions at 73, whether you need the money or not. Speaking of required minimum distributions, let's talk about that disaster. Once you hit 73, the IRS forces you to start withdrawing money from your traditional retirement accounts. They calculate a percentage based on your age and account balance, and you have to take it out and pay taxes on it, even if you don't need the money. I've seen retirees with $2 million in IRAs forced to withdraw $80,000 a year. They don't need it. They're already living comfortably on other income, but the government forces the withdrawal and forces the tax bill. It's brutal. And if you don't take it, they hit you with a 50% penalty on what you should have withdrawn. The IRS doesn't mess around. This is why Roth conversions can be smart for people in their 60s. You convert traditional IRA money to a Roth IRA. You pay the taxes now at your current rate. Then that money grows tax-free forever. No required minimum distributions, no taxes on withdrawals. You control everything. Yes, you pay taxes up front, but if you're in a low tax bracket now and expect to be in a higher bracket later, it's a brilliant move. Now let's talk about Social Security, because most people screw this up too. You can start taking Social Security as early as 62, or you can wait until 70. The difference in monthly benefits is massive. If your full retirement age benefit is $2,000 a month, taking it at 62 drops it to about $1,400. Waiting until 70 increases it to about $2,480. That's a 77% difference between 62 and 70. Here's my rule. If you need the money to survive, take it at 62. If you can afford to wait, wait until 70. Every year you delay increases your benefit by about 8%. Show me another investment that guarantees 8% annual returns with zero risk. It doesn't exist. Social Security is one of the best deals in retirement planning if you use it right. And Social Security is inflation adjusted. That's huge. Most income sources get eaten alive by inflation. Your pension doesn't go up. Your bond interest doesn't go up. But Social Security does. It's indexed to the Consumer Price Index. When inflation spikes, your benefit increases. That's real protection. Let me talk about one of the biggest threats to retirement wealth that nobody wants to discuss: healthcare costs. They're catastrophic. A couple retiring at 65 today can expect to spend $300,000 on healthcare over their retirement. And that's with Medicare. If you have serious health issues, it's way more. Medicare covers a lot, but not everything. There are copays, deductibles, things Medicare doesn't cover at all, like dental, vision, hearing aids. And if you need long-term care, Medicare covers almost nothing. A nursing home can cost $100,000 a year. If you need that for 5 years, that's $500,000. Most people don't have that kind of money lying around. This is why you need a health savings account if you're eligible. HSAs are triple tax advantaged. Contributions are tax deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. It's the best retirement account that exists. Max it out every year. Invest the money like your other retirement accounts. Let it grow, then use it to pay medical expenses in retirement. If you're over 65 and on Medicare, you can't contribute to an HSA anymore. But if you built one up before retirement, you can still use it. And here's a trick most people don't know. You can use HSA money to pay Medicare premiums. Part B, Part D, Medicare Advantage. All eligible. That's thousands of dollars a year in tax-free withdrawals. Long-term care insurance is another thing to consider. The premiums are expensive, especially if you wait until your 60s to buy it. But 1 year in a nursing home costs more than a decade of premiums. You're essentially buying peace of mind. If you never need it, you wasted some money. If you do need it, it saves your family from financial disaster. Now, let me address something that makes people uncomfortable: estate planning. If you're over 60 and you don't have a will, you're being irresponsible. If you don't have power of attorney documents, you're being reckless. If you haven't had the conversation with your family about what happens to your assets, you're setting them up for a nightmare. I've seen families torn apart fighting over estates, siblings who haven't spoken in years because mom and dad didn't make their wishes clear. It's tragic, and it's completely avoidable. Spend the money, hire an estate planning attorney, get your documents in order, have the hard conversations. Your family will thank you. Trusts can be powerful tools depending on your situation. Revocable living trusts avoid probate. Your assets transfer immediately to your beneficiaries without court involvement. Irrevocable trusts can protect assets from creditors and reduce estate taxes. If you've got a net worth over a few $1,000,000, you need to be thinking about this stuff and update your beneficiary designations. I can't tell you how many times I've seen someone die and their ex-spouse gets their IRA because they forgot to change the beneficiary after the divorce, or the wrong kid gets everything because the forms were never updated. Check this every year. Make sure your beneficiaries are who you actually want them to be. Let's talk about one more thing that destroys retirement wealth: lifestyle inflation. People work their whole lives. They finally retire and they think, I deserve to enjoy myself. So they buy a bigger house, a vacation home, a boat, expensive cars. They travel constantly. And within 5 years, they've burned through half their savings. I'm not saying don't enjoy retirement. I'm saying be smart about it. Your spending in retirement should be less than your spending while working, not more. You're not commuting. You're not buying work clothes. You're not saving for retirement anymore. Your expenses should drop. If they're going up, you're doing it wrong. Here's my rule. Live on 75% of your pre-retirement income. If you were making $100,000 a year before retirement, plan to live on $75,000. That gives you margin for error. It gives you cushion for emergencies. It means you're not drawing down your principal. You're living off income and letting your capital continue to grow. The math is simple. If you have $1 million and you're generating 10% returns, that's $100,000 a year. If you spend $75,000, you're reinvesting $25,000. Your principal grows to $1,025,000. Next year, 10% of that is $102,500. Spend $75,000, reinvest $27,500. You see how this works? Your income grows every year. Your principal grows every year. You're not running out of money. You're getting richer in retirement. But if you're spending cento, 000, or cento dieci, 000, you're eating into principal. Your portfolio shrinks. Your income drops. Within 10 or 15 years, you're in trouble. This is basic arithmetic, but most people can't do it. They spend emotionally, not rationally. Let me give you some specific investment ideas that fit this strategy. I'm not giving you financial advice. I'm telling you what I own and why. Canadian banks, TD, Royal Bank, Bank of Nova Scotia, these banks are oligopolies. There are 5 major banks in Canada and they control everything. They're incredibly profitable, they pay fat dividends, and they're safer than U.S. banks because Canadian banking regulations are stricter utilities. Companies like Duke Energy, NextEra Energy, Dominion Energy. People need electricity. They'll keep needing electricity. These companies have monopolies in their service areas, regulated returns, steady dividends, boring and beautiful, telecommunications, AT&T, Verizon. People need phone service and internet. These companies have huge infrastructure that's expensive to replicate. They generate massive cash flow. They pay high dividends. Yes, they have debt. Yes, they face competition, but they're not going anywhere. Consumer staples, Procter & Gamble, Colgate-Palmolive, Kimberly-Clark. People need toothpaste, soap, toilet paper. Recessions don't stop people from buying these products. These companies have pricing power. They raise prices to offset inflation. They've been paying dividends for over a century. Real estate investment trusts. I like healthcare REITs like Welltower and Ventas. They own senior housing and medical office buildings. As the population ages, demand for these properties increases. They pay high dividends because they're required to by law, and they benefit from long-term demographic trends. Preferred shares from solid companies, banks, insurance companies, utilities, these pay fixed dividends in the 5 to 6% range. They're more stable than common stocks, and they're senior in the capital structure. If a company runs into trouble, preferred shareholders get paid before common shareholders. That's 15 or 20 ideas right there. Mix and match. Build a portfolio of 20 to 25 positions. Spread across sectors. Focus on quality. Focus on dividends. Focus on companies that have survived multiple economic cycles. This isn't rocket science. It's discipline. Now let me tell you what not to do. Don't buy individual bonds. The bond market is rigged against retail investors. You're buying from dealers who mark up the price. You have no transparency. You're getting ripped off. If you want bond exposure, use ETFs. At least you can see the price and you're not getting gouged on spreads. Don't invest in anything you don't understand. If someone pitches you on a structured product or an annuity or some complicated derivative strategy, run. These products are designed to generate fees for the seller, not returns for you. If you can't explain it in one sentence, don't buy it. Don't try to time the market. I've been investing for 40 years. I can't time the market. You can't time the market. Nobody can time the market consistently. What you can do is stay invested in quality assets and ride out the volatility. Market timing is how amateurs lose money. Don't panic sell. This is the biggest mistake retirees make. The market drops 20%. They freak out. They sell everything. They go to cash. The market recovers. They've locked in losses and missed the recovery. It's financial suicide. If you've built a portfolio of quality dividend payers, the stock price fluctuations don't matter. The dividends keep coming. Stay calm. And don't listen to the financial media. CNBC, Bloomberg, all of them. They're entertainment, not information. They hype every move. They create fear and greed. They'll make you do stupid things. Turn it off. Focus on your portfolio. Focus on the fundamentals of your holdings. Ignore the noise. Here's my final point, and it's the most important one. Discipline beats intelligence every time. I know people with advanced degrees who are broke in retirement. I know people who barely finished high school who are millionaires. The difference isn't brains, it's behavior. If you can spend less than you earn, invest the difference in quality dividend-paying assets, reinvest the dividends, minimize fees, and hold for decades, you will be wealthy. It's that simple. It's not exciting, it's not sexy, but it's arithmetic, and arithmetic always wins. If you're over 60 and you're not doing this, start today. Not tomorrow, today. Every day you wait is a day of compounding you'll never get back. Restructure your portfolio, fire your advisor if they're charging excessive fees. Build your dividend machine, and then let it run. You don't need to be a genius. You don't need to get lucky. You don't need to find the next Amazon. You just need to stop doing stupid things and let mathematics do the work. That's how you protect capital and grow 10 to 12% safely after 60. That's how you retire with dignity and security. And that's how you avoid becoming another retirement horror story.